Hey everyone, it's Nima here. And whether you're new or a familiar face to this channel, I just want to thank you for clicking in. I try to make finance simple for beginners and more easily understandable, so in today's video we'll be talking about stocks, mutual funds, index funds, and ETFs. Now when I first started my investing journey, I thought all of this stuff was seriously really confusing, and I wish I had someone to help give me a better understanding of which direction to go instead of having to read a whole bunch of books and other stuff about it. So I made this video to cover what each term means, the good things about them, the not so good things about them, and I'll help you figure out which one is right for you. So let's jump in and get started. Now in the early days of the stock market, it was just that, a market of stocks. And while you can still buy individual stocks today, there are many different investment products competing for your attention. So let's start with what stocks are first. Stocks are small pieces of individual companies, meaning each stock represents a small bit of ownership in the company itself. Stocks are shares of publicly traded companies that are sold on stock exchanges like the New York Stock Exchange, NASDAQ, etc. There are over 3,500 publicly traded companies, from household names like Apple to Pepsi to smaller companies that you've probably never heard of. Now, there are two main ways to make money with stocks. One is by the stock appreciating in price. For example, if you were to buy a stock at $100 and it grows to $120, let's say, then you've earned a 20% return on your money. The second way that stock investors make money is by receiving investor dividends. A dividend is a regular payment that a company will pay to its stockholders. So for example, if you own, let's say, 25 shares of a stock in a company that pays $4 in dividends per year, then you would receive $100 in dividend payments each year. So that's simply 25 shares times $4 per share, which would come out to $100. Now, it's important to know that not all stocks pay dividends, and for the ones that do, they typically pay out quarterly or every 3 months. Now, I think some investors like stocks that pay dividends because they provide a steady flow of extra money, no matter if the stock's price is actually going up or down. It's essentially like having a side income from owning stocks. Now, all of that information aside, and the fact that you probably have a general understanding of what stocks are now, let me explain to you what the pros and the cons are, and let's go ahead and start with the pros of investing in individual stocks. Now, the first pro is liquidity. One of the advantages of stocks is that they're a liquid investment. Stocks can be bought or sold at any time on the stock market exchanges, during open market hours, or during aftermarket hours. As I get into it a little bit later, you'll learn that's something that you can't do with mutual funds. Now, the second pro is advanced trading now with advanced trading. You have the ability to make stop loss and trailing loss orders. Again, this is something that you cannot do with mutual fund owners that I'll explain later. A stop loss is a limit order that will only execute if your stock drops below a certain price. So for example, if you were to buy a stock at $100, you could set a stop loss order at $95. If the stock ever falls to $95, then the broker will immediately work to execute that order. Stop loss orders are popular because they limit the investor's risk. However, it's important to note that stop losses can only be executed during regular market hours, which is between 9:30 a.m. to 4 p.m. Eastern Standard Time. So keep in mind that stocks can fall in price quickly during pre-market hours, and by the time the market opens up again, your stock could have already fallen significantly below your stop loss price. So therefore, it's important to point out that stop loss orders don't eliminate risk entirely. Now, in addition to stop losses, you also have the option of a trailing stop. A trailing stop is an advanced stop loss order. So instead of setting a specific price as your stop loss limit, you can actually set a percentage. So for example, you could set 5% as your trailing stop, meaning that at any time that your stock drops 5% below its latest high, the sell order will execute. Now, trailing stops can be more effective at limiting your risk rather than stop losses. An example of that would be if you could imagine you buy a stock for $100 and then you set up a stop loss order at $95. Now you're accepting a 5% loss. Now, let's say the stock price goes up to $150. If it then falls down to $95, you would actually lose over 35% of your investment. That's the problem with stop loss orders. As the stock price increases, the potential loss becomes bigger if the stock actually falls. Now, on the other hand, the trailing stops actually solve this issue. Instead of setting a specific price as the limit, you set a percentage. So in this example, if you have a 5% trailing stop on your stock, it would have executed the sell order once the stock actually dropped down to $142.50. That's a 5% drop from the 150 peak that it hit as its highest point. This allows you to limit your risk more effectively because then the trailing stop just adjusts to the stock's performance and the potential gains rather than of its actual price. Now, personally, guys, I never buy individual stocks without immediately creating a trailing stop order. Now, another pro that I would like to mention is that annual cost stocks can actually be low-cost investments as well. Since you're not paying a fund that needs to pay fund managers, there's no annual expense ratio, and so you won't be charged a sales load either. Once you've purchased the stock, the expenses are virtually over. Now, the final pro, in my opinion, is that stocks are also a tax-efficient investing vehicle. While mutual funds can generate capital gains throughout your entire time as a shareholder, you won't get hit with a capital gains tax on your stocks until you actually sell your shares. So you can essentially just keep your money in your stock brokerage even while it's growing without paying any actual taxes. Just keep reinvesting that money if you would like to. Now diving into the cons of stocks, I would say that there are some pretty significant downsides. So let's take a look at what those are. Now overall, guys, stocks are fairly risky. Stocks are actually the riskiest of the 4 investing options that I'll be comparing in this video. Your investing success rises and falls on the performance of one particular company. If that company happens to tank, your portfolio will as well. That lack of diversification is the biggest downside to stock investing. Now, of course, you could buy a few different individual stocks to provide yourself some diversification, but keeping up with the performance of 10 or even more stocks can be seriously time-consuming, and you'd still have far less diversity than the average ETF or mutual fund. The next con I want to mention is that there are trading fees and commissions. Now, traditionally, brokerages have charged a trading fee when investors trade stocks. Trading fees are often less than $5, so for those of you who trade infrequently, this probably isn't that big of a deal, but if you were making trades every month, or even more often than that, your fees could add up fairly quickly and you could hurt your overall return. Now, I should mention that only until recently has there been a massive shift in the investing industry, as multiple brokers have removed their stock trading fees. Some of these brokers include Schwab, TD Ameritrade, Fidelity, and Robinhood. They all offer free trades, and it's probably only a matter of time before more brokers follow suit. But it's still something to keep in mind as you consider to move forward with the brokerage that you choose. Now, let's dive into what mutual funds are. Now, remember how I said the biggest problem with individual stocks is their lack of diversification? Well, mutual funds actually solve that problem. Mutual funds are groups of stocks. When you buy a share of a mutual fund, you're actually buying little pieces of hundreds of underlying individual securities. Whereas stocks can experience massive up and down swings, mutual funds tend to be a little less bumpy for investors. So if you are a conservative investor who wants to avoid market volatility, mutual funds can be a great choice. But I will personally advise against mutual funds as a beginner, and I'll explain why in a few minutes when we talk about the cons. Now, as for the pros of mutual funds, there are a few. Number one being asset allocation. Now, one of the biggest advantages of mutual funds is that you can actually match them to your specific risk profile, and the 5 most common types of mutual fund categories are growth, which consists of stocks that are poised to have an above average growth, growth in income, which consists of both growth stocks and stocks that pay dividends, value, which consists of stocks that are believed to be underpriced, balanced funds, which consists of both stocks and bonds, and target date funds, which with this portfolio, this type of fund changes to become more conservative over time. Now, the difference in each of these mutual fund categories mostly comes down to asset allocation. No matter your investing profile or your goals, you'll be able to find a mutual fund that is a good fit. Now, the second pro, in my opinion, is that mutual funds often come with professional fund managers. And if you're someone who's looking to invest, that might add a layer of comfort and security to you. However, you should know that since you have someone managing your fund, that's going to also add fees. Now, the third pro is dollar cost averaging. Most mutual funds allow investors to buy fractional shares, and that can make it easier to invest specific dollar amounts on a consistent basis. So, for example, let's say a stock and a mutual fund are both currently priced at $75, and you want to invest $100. With the stock, you'd only be able to buy 1 share, and you'd have $25 left over. But with the mutual fund, you can actually buy something around the lines of 1.33 3 shares. So it bleeds off a little bit into a second share of ownership. Now, being able to buy fractional shares is nice because you can literally put your investing on autopilot. And with most brokers, you can set an automatic monthly trade at whatever dollar amount you choose. So if you want to invest exactly $150 each month into a mutual fund, you can do that. And by doing that, you'd be taking advantage of dollar cost averaging. So in other words, when the mutual fund goes down, your $150 buys you more shares. And when the mutual fund goes up, it will buy you fewer shares. Now let's discuss the cons of mutual funds. One of the biggest cons of mutual funds, in my opinion, is their cost, and personally why I would advise against it. All mutual funds come with expense ratios, and the expense ratio on an actively managed mutual fund can be quite expensive, often ranging from 0.5% to 1.5%. And even though that doesn't sound like much, it definitely adds up. Now, the second con, in my opinion, is upfront sales loads. Now, many mutual funds also come with upfront sales loads, which can be up to 8.5% of the amount invested. Now, these are initial sales charges that investors like you or myself would pay for the initial shares that you buy. These sales charges are generally used by the fund to compensate the broker who is actually helping you. So right off the bat, you'd be 8.5% in the hole. Just to put that in another way, you would need your mutual fund to grow by at least 8.5% just to break even. Now, most mutual funds don't have sales loads that high, but many mutual funds come with loads between 3% to 5%. And in my opinion, guys, that's just terrible. Now, the third con in this case is liquidity. Another potential drawback of mutual funds is that they aren't quite as liquid as stocks. Unlike stocks, you can't trade mutual funds during the open market hours. Instead, mutual funds trade once a day, and that's after the market closes. So while you can get out of a sinking stock before it drops too far, you cannot do that with mutual funds. Even if you place a sell order at 10 a.m., your fund won't actually trade until the end of the day, so you could actually lose a lot of money within those hours. And last but not least, the last con, in my opinion, is the accessibility. Mutual funds often come with investment minimums of $1,000 or more. With stocks, on the other hand, you only need to have enough money to buy one share. So if you don't have a lot of money to invest, stocks or ETFs may be a better choice. Now let's dive into what index funds are. But first, let me clarify what an index actually is. So to put it simply, an index tracks the stock price of a group of companies that have some common features. For example, the S&P 500 tracks the market capitalization of the 500 largest US companies. This is the stock price times the number of shares available to the public. If the price of the stocks in those companies as a group go up, then the index rises. If the average stock price drops, then the index falls. Now, it's important to note that you can't invest directly in an index. It's not an actual investment, but rather information that's gathered and tracked. However, you can invest in an indexed fund. An index fund is a type of mutual fund that attempts to replicate an index as closely as possible. The S&P 500 index funds are some of the most well-known and popular, but there are index funds that track every type of market index. Some other examples would include total stock market index funds, Russell 2000 index funds, bond index funds, gold and silver index funds, and to be honest, there's many, many more. But since index funds aren't actively managed by fund managers, they are a form of passive investing. This is what I personally like the most, as it's great for long-term investors who are looking at low risk, low cost, low tax options. Now let's discuss the pros of index funds. Now, since index funds don't need to pay expensive fund managers to pick and choose the underlying stocks, they tend to be much more cost-effective than actively managed mutual funds. The first pro being the cost. Now, since index funds don't need to pay expensive fund managers to pick and choose the underlying stocks, they tend to be much more cost-effective than actively managed mutual funds. Now, while the average mutual fund expense ratio is about 1%, the typical index fund expense ratio will be below 0.2%. This could make a huge difference in a fund's performance over time and the money that you put in your own pocket. So let's say, for example, that you invested $10,000 in a mutual fund and in an index fund at the same time, and you contributed an additional $500 to each account per month. We'll assume that both investments earned a 9% return. Finally, we'll say that the mutual fund had an expense ratio of 1% and the index fund had an expense ratio of 0.2%. Now, the interest rate of the compounding schedule that you specified will show the growth to be worth over $780,000 over the next 30 years. Now, with the index fund, on the other hand, it would be worth over $913,000 in the same time frame. That's a difference of $133,000. And this example perfectly illustrates why you need to pay attention to your mutual fund expense ratios, because over time, it will really eat away at your earnings. Now, the next pro for me would be the performance itself. In the example above, we assume that the mutual fund and the index fund would earn exactly the same rate of return. But some advocates of actively managed mutual funds
might say things like, but an actively managed fund's expense ratio will pay for itself in better performance.
But the thing is, guys, from my experience, surprisingly, that's actually rarely the case. Index funds also tend to yield better returns than actively managed mutual funds. It turns out that an expert stock picker can't beat the indexes either. In fact, over 82% of actively managed mutual funds have underperformed the S&P 500 over the past 5 years, according to SPIVA statistics. To put it another way, 82% of the time, actively managed fund owners are paying more for a lower return. That's insane. So please, guys, don't invest in mutual funds. Instead, consider index funds. And you don't have to take this advice from me. Take it from Warren Buffett himself. In 2008, Buffett bet $1 million as a challenge to the hedge fund industry, which in his view charged insane fees that the fund's performances couldn't justify. Protege Partners LLC accepted his bet, and the two parties placed $1 million each. Guess who won? Buffett. Now, with all that being said, it's only fair that I mention the cons of index funds as well, though there aren't many in my opinion. Index funds share many of the same shortcomings of actively managed mutual funds too. They also can't be bought or sold until the end of each trading day, and many index funds come with investment minimums as well. Now, while index funds lack some of the features of stocks, they also have very few downsides when compared to actively managed mutual funds. The only exception would be that you won't be able to match an index fund with your specific risk appetite, as you can with, let's say, actively managed funds. And last but not least, guys, we have ETFs, otherwise known as exchange-traded funds. Now, what are they? Well, in 1993, a new investment vehicle called the ETF was introduced. It promised to offer the same advantages of index funds while removing some of their pain points. Like mutual funds, ETFs are funds made up of pools of security, but unlike mutual funds, ETFs are bought and sold on stock market exchanges, just like stocks are. Now, while there are some actively managed ETFs, most are designed to track market indexes just like index funds. That can make them very affordable investments, which is one of the reasons why many robo-advisors would use ETFs to build their portfolios. Now, getting into the pros of ETFs, the first one is liquidity and advanced trading. Since ETFs are traded on the exchange like stocks, they can be bought and sold at any time. You don't have to wait for the market to close. And as with stocks, investors can make advanced orders or trade during the pre-market and or after market hours. The second pro is accessibility. ETFs don't come with investment minimums. As long as you have the funds to buy one share, you can get started with ETF investing. And that's why this makes ETFs a great choice for beginning investors. With ETFs, investors can literally enjoy the diversification of an index fund with an investment amount of less than, let's say, $100. Now, the cons of ETFs, however, are similar to that of stocks as well. Some brokers still charge commissions on ETF trades, although this has become less common over the past year. It's also less common for brokers to allow investors to buy fractional shares of ETFs, although some say that they'll be adding this functionality soon. So, if you're a fan of dollar cost averaging, an ETF might not be your best option. Now, the bottom line is, guys, investing products have continued to improve over time, and in many ways, it would appear that ETFs are the culmination of years of iterations. If you're just getting started into investing, I would personally recommend index funds or ETFs to be your best choice. However, you may already have a lot of money invested in your broker's funds, and that's totally fine. Mutual funds are still a great investment product, even if it pulls money from you in the long term. As long as you're paying a low expense ratio, then you should be okay. And finally, if you are a big market watcher and you are constantly researching companies and their successes, then stocks may be the way to go for you. If you do decide to buy individual stocks, I would recommend that you use only a small percentage of your total investment capital. Stocks are simply too risky to place a high percentage of your retirement money in them, and if you decide to buy stocks, consider using stop loss or trailing stop orders to limit your risks. All in all, guys, I hope this video gave you a better understanding of all of the different options that are out there. If you managed to watch this far, I would really appreciate it if you could hit the like button, subscribe, and comment as well for more future videos just like this, and go ahead and give me some recommendations of what you would like to see next. See you at the next one.